Greetings, accounting students. This video is going to be about, you guessed it, balance sheet items. So I'm going to go through a whole bunch of different balance sheet items, which I hope will give you guidance for our next task. Current assets. What are they? They are assets that you expect to convert to cash or to consume, use up within 1 year. Our favorite current asset, and they're listed, by the way, in order of liquidity for the most part. In other words, what is most readily converted to cash? Well, cash is most readily converted to cash. And what is a cash equivalent? That would be a short-term security like a treasury bill that comes due within 30 days. Very little chance of any major market fluctuation. So sometimes companies will group these together. Trading security. Okay, so this is going to be, think of it as a portfolio of perhaps stocks and bonds, and you are trading these securities very frequently, possibly on a daily basis. Okay, and to the extent that the amount that was paid for these securities differs from the fair market value at any point in time, typically a balance sheet date, you would have an adjustment in this account. So if you bought, let's say, stocks for $100,000, the account trading securities will show $100,000, will show the cost. If the market value has decreased to $85,000, then you'd have a credit balance in the securities fair value adjustment account for $15,000, the difference between the cost and the fair value. That's what that is. Okay. And obviously you can convert these to cash probably within 24 hours. Okay, accounts receivable, we know what that is, right? You sell a product or a service and you are allowing the customer or client to pay off at a time beyond the original sale date. So we have an account receivable. Now sometimes our trusty clients or customers won't pay, so what we have to do is establish a contra asset account, we call the allowance for doubtful accounts. So maybe there's $250,000 owed to your company by a whole bunch of different customers, and we estimate that, let's say, $10,000 is not going to be collectible. So what do? You take the gross amount of receivables, you subtract the credit balance in the allowance account, and you get what is known as the expected realizable value. Okay. Notes receivable short term. Well, any note receivable with a due date which is on or before 1 year hence is going to be a short term note receivable. Advances to employees, which is or employee loans. This is typically not a lot of money, but this is money that's given out to employees possibly to go on a business trip, or employee loans. Accrued revenue and income is the result of an adjusting journal entry, which you are now experts on. Remember Kerry, Milo, Riva, and so forth. Okay, so for example, you might have interest receivable as your debit and interest income as your credit, and the interest receivable goes here. Securities available for sale. This could be the very same securities that we had up here, the difference being that the frequency of trading is not nearly as often. So if you have a security available for sale and you are classifying it as a current asset, what does that mean? It means that you intend to hold the particular security for less than 1 year. And to the extent that the cost of the securities that you purchased differs from the fair value, you have another adjustment account, which could be a credit balance if you're losing money on paper, be a debit balance if you are ahead of the game on paper. Now the difference between these two is frequency of trading. Yeah, there's another difference. So let's say over here you lost $15,000 on your stock. That loss goes on the income statement. Okay. The offset to this, let's say you're out $15,000. Well, you're going to credit securities fair value adjustment. Okay, what are you going to debit? Well, you're going to debit this account down here. other comprehensive income or loss. So what's the bottom line? The bottom line is that the unrealized holding gain or loss on a security available for sale does not go on the income statement. It goes in the stockholders' equity section. If you're ahead of the game, your fair value is greater than your cost, this is going to be a credit balance. If, on the other hand, you're losing money on paper, this is going to be a debit balance. Now, in stockholders' equity, when you have a debit balance, that reduces the total. Okay, let's go back to our list here. Inventory. Okay, that's the stuff you buy low and sell high, we hope. Or perhaps you're a manufacturer. If you're a manufacturer, you have three different kinds of inventories. You have the raw materials, the work in progress, and the finished goods. So this is a topic which is covered in great detail, typically in a course called cost accounting and also in managerial accounting. Okay, recoverable income taxes. So we fill out our corporate tax return and guess what? We have a refund coming. Well, there it is. That'd be a current asset. Prepaid expenses, you know what they are, right? Prepaid insurance, prepaid maintenance, prepaid advertising, prepaid rent. It's going to be consumed within a year. It's a current asset. Supplies, which you almost never see on a real balance sheet, but we see them in Accounting 1 and even in Intermediate Accounting. Current asset. Deferred tax assets, that's a Accounting 202 topic. I just put it there anyway. Investments. Okay, investments. If you have something in a caption, under the caption investments on a balance sheet, it is going to be long-term by nature. In other words, more than 1 year in the future. So if you have a note receivable that comes due in 2025, then it's going to be in the investment section. You say, what's this here? Isn't that the same thing we had up here? Well, if the intention of management is to hold the security available for sale for more than 1 year, you would put it in the investment section. And you still have that security fair value adjustment, the offset going into stockholders' equity. A bond sinking fund, what is that? That is money set aside, hopefully for the ultimate repayment of a bond issue. So let's say a company has a $50 million bond that comes due in 5 years. Well, they want to set aside some funds. It's going to go in this section here. So this could be anything. It could be stocks, bonds, who knows what. Hopefully not bitcoins. Next, cash surrender value of officers' life insurance. So if you have, the company has life insurance on executives where the loss payee is the company itself. So if the president should meet with an early demise, the company will receive the life insurance payout. And if you have a cash surrender value, it's typically what's referred to as whole life insurance, where you're paying in premiums and you're having the insurance coverage, but you're also building up an investment account, which sounds great on paper, but in reality, it's not really the best deal. Investments accounted for under the equity method. That's another 202 topic. What's happening here is your company owns 20 to 50% of another company, which is obviously a very large holding, and you have substantial influence. You're going to use the equity method of accounting. And it's going to go in this section here. And that's another 202 topic. Assets held for speculation. You bought a Van Gogh painting and you're holding on to it, hoping that the price goes up. Asset held for speculation. Held to maturity securities. This can only be some type of bond or note. So let's say your company is holding $100,000 worth of bonds that come due in 2026, and the intention is to hold the bonds until 2026. It goes over here in this section as a long-term investment, and it is carried on the balance sheet at its amortized cost. Okay. Now, in reality, let's think about this. If we really, really needed the money, We could cash out these trading securities, have the money within 24 hours. Same thing for these securities here, securities available for sale. And even these guys down here, although they're classified as long-term, and that's strictly based upon the intention of management. But you might just change your mind, say, we really need the money. You might even cash out those bonds that you were going to hold on to. Okay. Deferred tax asset long-term, another 202 topic. So if you sign up for that course, that's a pretty gnarly topic. Property, plant, equipment. Okay. Got a whole section of this coming up later on in the semester. So what are the attributes of property, plant, equipment? So it's going to be long life, used in operations, not intended for resale, and it's going to depreciate over time except for land. Okay, so this describes a lot of assets. Buildings, planes, trains, trucks, machinery, equipment, furniture, fixtures, etc., etc. The one thing they never seem to mention in the textbooks is that there's going to be a dollar threshold. So if you give you an example, let's suppose you have a contractor, does home improvements, goes to Lowe's and buys a hammer for $20. Let's see now. Is it used in operations? Yes, it is. Is it going to have long life? Yeah, it could be 10 years. Could be more. Is it intended for resale? Absolutely not. You have an emotional attachment to this hammer. Okay, so it qualifies under all of the attributes of property, plant, equipment, but it's not a lot of money. So what are you going to do in real life? You're going to expense it out immediately. Yeah? It's not worthy of being carried in this section and depreciated, right? So what do we have in that section? We have all those different assets, and we also have accumulated depreciation, which is going to have a credit balance. It's going to reflect the total depreciation over that particular category of asset over its entire existence up to now, right? That's why it's called accumulated depreciation. What's this? Oh, leased assets. Long story, but let's just say the following. You leased out, let's say, a building for 20 years. In the old days, and when I say old days, we're going back into the 70s now, I believe, you would make a rental payment, you'd debit rent expense, you'd credit cash, and you would not show any liability on your books and records. So now the way it works is, even though we're calling it rent, we are going to capitalize those payments, and those leased assets will show up on our balance sheet. That's not something we have to worry about right now, but that is another gnarly topic in Accounting 202. All right, intangible assets, they lack physical substance. Yeah, goodwill is really intangible and could be completely fallacious in nature. So if you go back into the 90s where we had the dot-com bubble, companies were buying up these small dot-com companies, and they were paying huge amounts over the book value of the company. A lot of goodwill was recorded, but actually it was just bad business deals, and it had to get written off. Okay, patents. What happened? We bought a patent from some scientist for a particular product or service. It goes in this section here. So when you purchase a patent, it's easy. It's whatever the patent cost, and if you have any successful legal challenges against your patent, that would go in there as well. Self-developed patents, a very limited amount, can be capitalized. Copyrights. Okay, so you own the rights to what? To Led Zeppelin recordings. Okay. Obviously, would have paid a lot of money for them. Would go in here, get written off over time. You own a franchise, a McDonald's franchise, goes in here, intangible asset. Leasehold. Okay, it's one you don't see in the textbooks. You acquired another business. Now the business you acquired had a long-term lease, and the monthly rent under the lease is $10,000. But it's a really good lease, and Everybody else in the neighborhood is paying $12,000 a month for the same square footage. So you have the economic benefit in buying the company and having the leases signed to you. You have the economic benefit of paying the $10,000 a month as opposed to $12,000. Are you going to get this for free? Of course not. So the company that's selling to you is going to charge you, and that's what we call leasehold. You write it off over the remaining term of the lease. Then we got 2 franchises. You only need 1. Restrictive covenants. My wife always complains that I watch all these shows about murder and mayhem. Well, one of those shows, obviously about a murder, what happened? There was this business. I believe they were building those really long, super fast boats that I understand are used for smuggling things. Okay. And it was sold to another business. So Company A sold their boat building business to Company B. Then Company A went down the block and opened up another company that builds boats. So what should have happened was, in the contract for the sale, there should have been a restrictive covenant which says that, the seller cannot compete with the buyer within some geographic region over some period of time. Okay, otherwise you could buy a business, right? And then whoever sold to you could go right across the street and open up another business, which would be terrible. Anyway, to the extent that that's quantified in the sale, you have a restrictive covenant, which is an intangible asset. Security deposit. Oh, you got a security deposit with PSE&G. Okay, so that's where you'd put that. Current liabilities. What's the story here? These are liabilities that we expect to pay off or to resolve an obligation within a year. Okay, so if you have a note payable, we're doing the balance sheet as of December 31st, 2020. You have a note payable that comes due anytime during 2021. It's going to be short term. Let's suppose you have a mortgage note payable and there's 15 years to go. Well, the amount that you're going to pay off in 2021 is a current liability. The rest of the mortgage note would go where? Down here, the non-current portion of that same note. So maybe you owe $1 million, okay, and this is $100,000. That's what's going to pay off next year. This is going to be $900,000. The amount you're going to pay off over years 2 through, let's say, 15. Those capital leases, that's a 202 topic, and they result in the establishment of a liability. Obligation under warranty. So you're selling a product, let's say it has a 5-year warranty. Well, you estimate how much you think you're going to have to spend to honor the warranty over the next year, and it goes in this account. The other years, if it's a 5-year warranty, years 2 through 5, your estimate goes down here in long-term liabilities. Accounts payable, we know what they are, right? Bought something, a product or a service on account, you probably got 30 days to pay. Accrued expenses payable, those are the result of those exciting adjusting journal entries we made. So, for example, you debited utilities expense and credited accrued expenses payable. Unearned revenue or income, okay? Your company received the cash advance prior to earning the money, okay? So we take our favorite baseball team, which of course is what? The New York Yankees, yeah. And they have collected huge sums of money for fans that are going to attend games in the 2021 baseball season, which is going to probably begin somewhere around April 1st. So what do? They get the money, they debit their favorite account, cash, and they credit unearned ticket revenue. It's a liability account. And when they play the games, they debit the unearned revenue account and they credit, say, ticket revenue. This is in sharp contrast to who? the New York Mets, right? Well, they are not collecting large sums of money. They are collecting very small sums of money because there just aren't enough Met fans with any money. And even after they play the games, the Mets have not earned the money. Next, dividends payable. You declare a dividend. Let's say in December 15, 2020, you declare a dividend. Well, at the time, you're going to record the dividend, and you're going to have a dividend payable. Let's say you intend to pay that dividend on January 15th of the next year. Okay, that's how you have a dividend payable. It's the time between the actual declaration of the dividend and the payment of the dividend. There will be a dividend payable. Payroll taxes payable are very, very current because the government wants their money almost immediately if you're a large company. Smaller companies can pay less frequently, let's say monthly or quarterly, but if you're a big company, you're going to be paying every week. Income taxes payable. Okay, so you have a corporate tax return, there's money due, you have income taxes payable. Deferred taxes, that's a 202 topic, very complicated. Let's see, long-term liabilities. Okay, we know what this one is, right? So if we're doing the December 2020 balance sheet, we got a note that comes due in 5 years, goes down here. It's the current portion of a mortgage or any other note, right? Installment note. So we deduct the current portion from the total and we put it down here. This is, again, that 202 topic. This is pretty much all these obligations under capital lease. It's kind of like a mortgage payable situation. Okay. Bonds payable. What do we got? We issued bonds. They are $1,000 face value. If we sell the bonds for less than $1,000, they'll be at a discount, which we learned in Accounting 2, Accounting 102. And if you sell the bonds for more than $1,000 face amount, you have a bond premium. So you have two accounts. You have the bonds payable, that's going to be a nice even multiple of $1,000. And then you have either a discount account, which will be a debit balance, or a premium account, which will be a credit balance. Here's our warranty again, right? All of the cost you estimate after beyond 1 year from the balance sheet date. Come down here, and what do we have? Stockholders' equity. Common stock is typically the voting stock. That's when you always hear about it on all the business networks. Preferred stock is almost like debt. So if you have preferred stock, it's $100 par, 2%. What does that mean in English? That means you're going to get a $2 a year dividend, or if you're the company, you're going to pay a $2 a year dividend. To the extent that you issue stock in an amount above the par value, which happens very, very frequently, you have another stockholders' equity account called paid-in capital in excess of par. And you might have one for each of these types of stock. Retained earnings, we know what that is, right? That is the lifetime earnings of the company in its simplest form, the lifetime earnings of the company minus any dividends that have been declared over time. Where the name comes from, right? Retained. So you earned the money and you retained X amount of dollars. There's a number of other transactions which can take place and influence the balance and retained earnings. But that's in the simplest case. Other comprehensive income or loss, well, for now, we'll just stick with this one here. The unrealized holding gain or loss on securities available for sale. Right? So that, which we know the securities available for sale could either be current or could be in the investment section. Either way, the unrealized holding gain or loss goes here. Treasury stock. We went out and we bought our own stock. Company bought their own stock on the open market. Now, why did they do that? Well, there's a number of reasons they could have done that. One is to possibly because they believe. By the way, who has the best knowledge of how a company is doing? The company itself. So if they feel their stock is undervalued, they might just go out and buy a ton of it, right? That took place in the 1990s. IBM went out and bought $1 gazillion of their own stock back because there was a temporary decrease which had occurred due to some wartime event in the Middle East. They went out and they bought their own stock back. Another reason companies might buy their own stock back is to avoid or reduce the possibility of a hostile takeover, to reduce the number of shares outstanding. Okay. Could also just be buying the stock to give it out to your employees. Okay, so there you have a description of these different items, which will come in handy when we look at our adjusted trial balance. We should be able to fit all of our amounts in here somewhere, and hopefully it adds up. Okay, so that's it for now. Until next time.